Hi, welcome back. Holding steady for the market. So let's get talking about our personal finance segment. Harshvardhan Roongta of Roongta Securities joins in to talk about a question which plagues a lot of people all the time. That considering the amount of volatility that we've seen, even especially of late, what would you recommend to small investors? Nibble at equities or possibly explore other asset classes?
Well, Ekta, there is a fact which every investor needs to keep in mind. The first one being that equity markets are volatile and will always remain volatile. The second fact is, since the way there is no substitute to hard work, within a portfolio investment there is no substitute to diversification. So moving out completely of one asset class because it is volatile, or investing into an asset class only because it is volatile and gives you potentially high returns over the long term, may not be a wise thing to do. What an investor needs to do is diversify and balance his investments into different asset classes. Okay, let's take an example. Now, there is a risk associated with every asset class. For instance, a bank fixed deposit, confers upon saying that, okay, the capital remains safe, but there is an inflation risk.
Right.
While in equities, there is some risk that is on the capital, but it takes care of inflation. So again, reiterating a point, there needs to be a balance. Let's take an example of an investor who has 1 lakh to invest for a period of 5 years. The first thing he does is, he puts 70,000 rupees into debt and 30,000, which is 30%, into equities. Now let's see what happens after 5 years. Scenario 1, a debt investment, current situation, you will get a 9% returns. 70,000 has become 1,07,703. The 30,000, scenario 1, the markets have done very well. He's got a 15% returns on the equity component. So 30,000 invested has become 60,340. So total return on the portfolio is about 10.93%, almost 11ish, which beats inflation hands on. Scenario 2, equity markets have not done anything. They remain flat, which is the case in the last 5 years that we've seen in Indian equity markets. 30,000 invested has remained 30,000. In that situation, it's also the investor will get 6.6% returns on his total investments, 9% from debt and no returns from equities. In a scenario 3, equity markets have betrayed him. A 30,000 investment has become half to 15,000 rupees. In that situation also, he gets a return. He's invested 1 lakh, he gets 1,22,703 rupees. So the returns on the total portfolio, the yield works at about 4.17%. The idea is, when he is taking a calculated risk and balancing his portfolio in such a format, he ensures one thing, which is his capital is protected. Secondly, he is attempting to beat inflation. Yes, there is a notional loss of the returns he could have gained in the worst case scenario. However, the capital is protected. So whenever you are making an investment, the idea is, unless you take those kind of calculated risks, you will never be able to beat inflation. Secondly, if your objective is to protect capital, you lose sleep if you lose capital. So that at least you can divide it with the 30 and 70 ratio, so that at least after 5 years your capital is protected and you get nominal returns, which is the savings bank returns, at least on your portfolio. So answering the query, there has to be a balance in your portfolio. Volatility should not lure you into equities, nor even drive you away from equities.
Run out of time. Thanks a lot, Harsh, for putting it so lucidly. It always pays, and today at a time when debt gives you decent returns but equity isn't, this is a good advice to remember. We'll wrap up this edition of Markets and Macros. On that note, thanks for watching. Business Lunch coming up in a minute.
MCX Stock Exchange, India's new stock exchange, presents Markets and Macros